Hi everyone, hope you're all doing well, and today I'm doing a bit of an education video and I'm going to talk about buying the dip. So as you know, at the moment there's a lot of stocks down. In fact, yesterday was actually a good day though. Yesterday was a really good day. I forgot what green looks like in the stock market portfolio, but we had it yesterday. But one good day doesn't undo the 30 ugly days that we've had recently. And I thought, well, it was a good day yesterday, but let's not get carried away. Let's just, look at the long-term picture. And over the last kind of couple of months, it has been quite ugly for, if the indexes, the big tech have all done very well and creating this false image around the stock market where if you actually look past that, there's a lot of stocks that are down a huge amount this year, and a lot of them are creating big dips and potentially good buying opportunities in them dips. So I thought we'd just do a little bit of an update talking about that situation and just a few things of where we're at right now. So hope it's a little bit useful. If it is, make sure you hit the like button. If you are on Patreon, there's a new exclusive video on there which is talking about stocks that you own and just little mini updates on them and when I'm buying them certain stocks. And just to let you know, Freetrader are currently doing a special offer where if you join through them, you get a free share worth a minimum of £10 up to £200. Well, let's go on to buying the dip. So first of all, the big thing you got to realize, and I think a few people have been caught out with this, especially because of, if I'd say probably potentially the new investors that have basically been in the stock market probably since April, May time last year. We've had a stock market that has just uptrended, and this year was the first kind of year where we've had not the indexes or the big tech, but basically anything out of that has had a little bit of a wobble this year. And it was a bit of that reality check of, okay, we don't just go up in the straight line in the stock market. It has wobbles sometimes. And in fact, we have a stock market which can go down quite a bit of a way of, stocks down 20, 30, 40. And if you're going for a little bit more of those high risk stocks, which people always see, high risk, high reward, people forget about the high risk part. And they have periods of time where they can be very volatile and lose 30, 40, 50% of their value within a couple of months. And quite often that can be for, no reasons at all or big massive overreactions. And it is a little bit tricky until you get used to that sort of thing happening. So we have had a stock market that has been a little bit wobbly, and we've had quite a few stocks that have gone down a huge amount. It is that kind of reality check of that we don't just go in one direction. And it is getting used to that, if any of you guys were in the stock market before, April, May 2020 time, if you were in before that, 2019, maybe the start of 2020, you guys have got that feeling of what it's like to go through a dip and then come out the other side. And granted, the dip that we went through in the CV times was actually, it was a very fast dip. It was a stock market which just went, fell off a cliff, boom, straight down. It was really ugly. Some stocks were down, 10, 20% every day, and it was just going down a huge amount. But also that was a stock market that recovered very fast as well. So it was ugly because within a couple of weeks, I think personally for me in 2020, my stock market portfolio was down like 50% within a month. It was really ugly. But the thing is that a lot of that recovered within 2-3 months. So it wasn't really like a normal dip because it was ugly. It was testing because you did go through that, and it was so fast that it went down, but then it recovered so quick. But there will be other periods, of 2018 comes into mind, where there'll be a stock market that does go down that much, but it's probably even worse when it's where you are buying the dip, and what happens, it's just every kind of 4 days you go down, and then maybe have one day that goes up, and then you have 4 days that goes down again, and one day that goes up, and you just slowly downtrend. That's even worse because you just, every kind of week you're looking at it, and over a couple months period, you're just looking at it going, I just keep going down and buying, boom, go down even lower. That's probably, those are really tricky markets to go through, and then it starts getting to you a little bit where you go, it just keeps down trending after a bite in the dip. And really you need to focus on the long term, because in the long term, a lot of these dips will give you really good buying opportunities. 2018, where we had a stock market that dipped, some of the stocks I still own from that period of time, JD.com was one that I bought that went from like $45 or $50 all the way down to like $18. Fantastic. That was a stock that had the whole year of just dipping down. But you look now, I'm up 300, 400% on that stock. One of my best returns at the moment. I went quite heavy on Microsoft. Compared to last time where, right now that's a stock that's doing phenomenal. Even Microsoft got caught up in it in 2018, and that went down a fair bit. And there was a few other stocks. So, what that showed is that when you do buy them dips, they can be really good buying opportunities. And even 2020, some of you guys that would have gone through that will realize that when you buy them dips, they can be the best times to make money, even though it is the hardest part of investing. It's the hardest part of investing because you keep going on your account, and your account, you keep going down, and it's like when you're in there, it is really tough to get through the other side, and you do go start thinking, is this ever going to go back in the right direction? And it will do. In the long term, a lot of these stocks, as they continue to improve and grow their revenue, or even grow their profit, they will move back in the right direction, even though it does seem a little bit tough in the time. And the best thing you can do for these situations is have cash. I think a few people always have to learn this the hard way, is they go through a dip, then they don't have the cash to buy it. If you don't have the cash to buy it, then you don't benefit from the dip, which are normally really good buying opportunities. And as well as that, you can't get your averages down any lower on these stocks. So the big thing is to capitalize on any dip is having cash there. And sometimes, unfortunately, you have to go through a dip without cash to go realizing, I need to start keeping some money on the side. And that's what I do personally. I like to have my cash balance around the 30 to 20% mark. As long as I keep my cash in there, then when we do get to the dips, I can start deploying that cash into these dips. And that's what I've been doing quite a bit recently. I did get up quite high on cash, especially from selling a little bit of my Tattoo Chef position. I also took a nearly 100% gain on Tesla. So my cash pile was really healthy going into these last kind of few months. And now I've been buying that dip a huge amount. My cash pile is starting to get a little bit lower now. I think I'm only just slightly above 10% right now. But I've been deploying that cash, and as long as this dip continues and it even goes even lower, I just keep burning through that cash and keep deploying it to buy these dips, because in the long term, I think there's some really good opportunities out here. And tying into cash is nibbling away. The big thing is what people do get caught on is these dips is that as soon as we have the first kind of 10-20% drop in it, is going all in. But the problem is that what happens if you go down even 30, 40, 50%? You've got to also be prepared that you don't go all into one stock when we do have dips. It is really important that you just nibble away, and that's what I've been doing every time. I've been just doing a little bit of a nibble on certain stocks. So that stock there, I'm going to nibble, increase my position by 5%, that stock increase it by 10%, and just nibble away at these stocks rather than going all in. And then what is the one thing that's horrible is that you buy the dip and then the dip keeps dipping. Now, it is frustrating that it does keep dipping, but as long as you get cash, you go, okay, I'll buy it again. Because as long as you know where it's going to be in the long term, every time the dip goes lower, that should mean potentially more upside because it is now lower. Conviction. When the stocks dip, it is a very big test of conviction. The amount of times I've seen people buying stock names or just ticker symbols and not really having much conviction in the stock, and the big test is that you buy a stock and then it goes down 50%. If you don't have high conviction in the stock, it's funny to see how many people realize that after the share price goes down 50%. If you have, okay, this is what this company does, this is what the revenue and profit will be in the next 5 years, when they get there, the share price could be somewhere in this range. If you have done your research and you've got conviction in that stock, you have that share price drop, you're probably looking at it going, okay, it's half the price, I'm probably going to buy it. But if you've just been buying ticker symbols or following people without any of your own research, and then that stock drops that much, you're probably looking at it and going, oh crap, what do I do? What do I do now? Should I buy it? And that's the thing is, when you have the share price drops, it is a very good test of how much conviction you've got in it, because then you're looking at that and am I willing to put any more money into that? So this is a really good thing about dips, is that it does really start testing your conviction on a lot of stocks. Next up, timing the market. A few people I've seen do this a little bit now is going, oh, you know what, I'm not going to buy anymore. I'm just going to wait until the bottom and then try time it and buy it. You can't do that. I remember back in 2020, a lot of UK stocks were kind of flatlining for a little bit, and there was fears of, is there going to be a winter lockdown? Is there anything going to be like that? And I remember people going, okay, I'm going to sell my stocks now, or and wait until we get some positive news, or I'm not going to buy anything now until we get past winter. And what happened within about a month's time is the vaccine news came out. And within one day, a lot of UK stocks, and it was in the US as well. I remember the likes of Wynn doing this and everything, but they jumped like 20% in one day. Now, if you try timing the market, you've just completely missed the bottom and missed massive gains. As long as you were averaging in, you won't miss out on the gains. That's the big thing. So don't try time it. The best thing is just to average in. You don't need to be in the bottom as a long-term investor. You only have to be somewhere in that range to make it up to that upside. So that's what I'd say on that. And the last thing, which I kind of said already, is when buying the dips mean more money. That's the big thing. If you've got high conviction in your play and you keep buying that dip, you're probably going to give yourself more upside, because if you start buying a stock and it starts downtrending, where you start buying it, you know, there might be 100% upside. If that stock then starts losing a lot of that value, the more it goes down, you could potentially have 120% upside, 140% upside, 150% upside. So dip shouldn't be something that you look at negative, because in the long term, as long as you've got high conviction, if it's still going to go in the same place, if the fundamentals haven't changed with the company, if a stock you buy is dipping and loses half its value, you should be looking at it going, there's nothing changed with this company. Now that that share price is even lower, the upside that I have on this has increased. I'm going to make more money from this. So the big thing is dips equal more money. And like I said before, you know, with a dip, you don't have to be exactly at the bottom of a dip. All you need to do is, make that average a little bit better. As long as you're making that average a little bit better, you're going to make more money in the long term. And that's the big thing. You know, don't try timing it. Just bring that average down. If you're bringing that average down, then the upside that you'll have in the long term is more money. So that's the big thing, is people always look at dips and look at dips like negative, and I'm fed up of it dipping. But as long as you've got high conviction in a long time frame and you're actually a long-term investor, you'll be looking at a lot of these dips right now and thinking, I'm going to make even more money on this. Something like for me, which is like a DraftKings, for example. In the next kind of 5 years, I'm looking at DraftKings and thinking DraftKings could easily be $200 plus. I think it could easily get above $200 in the next 5 years. Now, I look at DraftKings when I was buying at $60 and I was thinking, okay, I'm paying a fair valuation for this. It's definitely not overvalued, but it's not cheap either. And I think there's a lot of upside here. But then I look at DraftKings now and I go, now the stock's at $30 and I still think it's going to get there. The upside potential now for me on this stock is huge. So I just keep averaging down, and sure, it stings a little bit in the portfolio, but I'm not bothered about what that portfolio is doing in the short term. I'm more bothered about where it's going to be in the long term. And I look at that now and think the upside that I have is absolutely amazing. So I'm going to keep buying on that opportunity. So yeah, I thought I'd just do a bit of an education video, just talk about these few points and just a bit of a reminder of where we're at and where we're at going forward. Obviously, it's been a bit of a green day yesterday, and it might be okay today. We'll see what happens, but there's still a lot of a way to go, and a lot of stocks potentially that people have been buying over the last kind of couple of months. A lot of people will be down on a lot of stocks they've been buying in the last couple of months. So I still think this video is quite relevant for what's going on at the moment anyway. So I hope you enjoyed it. If you did, hit the like button. If you're new, subscribe. I'll see you next video.